The American dream is a myth. That's what a growing majority of Americans now believe. The foundational promise that hard work guarantees economic gain and a stable life is being crushed by a financial reality that feels rigged. Look at the numbers. Since the 1980s, the vast wealth accumulation in the US has gone almost exclusively to the top 10% of earners. The wealth of the bottom 50% of households, it's only about 2.5% of the country's total. Meanwhile, the middle class is shrinking, with an increasing percentage of Americans feeling they're running in place or even sliding backward. The primary suspect in this economic crime? Wall Street. This isn't about blaming bankers for being rich. This is about analyzing a fundamental shift in the US economy, one where a philosophy of maximizing shareholder value has replaced the mission of building a thriving national economy. We're going to show you the three financial mechanisms driven by Wall Street that have systematically dismantled the economic ladder for the average American worker, and how, by prioritizing financial engineering over industrial investment, the American economic engine is now running in reverse. The question is, can this financialized system survive the loss of the very economic class it depends on? To understand how Wall Street is implicated, you have to rewind to the 1970s and 80s. This period marks what economists call the Great Divergence. For decades after World War II, corporate profits grew and worker wages and productivity generally rose in tandem. The system was balanced. But then the economic philosophy of shareholder primacy took root. This doctrine dictates that a company's sole legal purpose is to maximize returns for its shareholders. The priorities shifted, not towards innovation, higher wages, or community investment, but towards short-term stock price elevation. This is where the financial sector, Wall Street, steps in and begins to dominate. The Federal Reserve now reports that the top 10% of U.S. households own over 67% of the total household wealth. The bottom half? They hold a mere fraction of that, just 2.5%. This isn't just an inequality gap, it's a chasm created because the primary mechanism for generating wealth in America became owning financial assets like stocks and bonds, not earning a higher salary from work. And who owns those assets? The data is clear. The richest 10% of households own over 80% of the stock market wealth. If corporate profits are funneled through the stock market, they flow overwhelmingly to the richest. The old path to the American dream, a good job, a pension, and a house, is now superseded by the need to be a major shareholder. If you're not invested heavily in the market, you're not just missing out, you're being left behind by design. But how exactly does Wall Street ensure this upward transfer of wealth? It starts with a simple yet devastating corporate practice.
The first major tool Wall Street popularized to accelerate this wealth transfer is the stock buyback. This isn't a technicality. It's a systematic way to take massive corporate profits and pump them directly into the stock price, benefiting shareholders and executives. What is a stock buyback? It's when a company uses its excess cash to purchase its own shares from the open market. This reduces the total number of shares outstanding, which mathematically increases the earnings per share, boosting the stock price immediately. Now, historically, this practice was rare, and before 1982, it was even considered a form of market manipulation. But an SEC rule change in 1982 opened the floodgates. The results are staggering. Since the early 2000s, S&P 500 companies have spent trillions of dollars on buybacks. For context, in the 10 years leading up to 2022, companies spent over 90% of their profits on buybacks and dividends. Think about what that money didn't go toward. It didn't go into higher wages for the middle-class workers. It didn't go into new research and development to grow the company's long-term competitive edge. It didn't go into new facilities or equipment that would create more jobs. Instead, that cash went straight to the top, where stock ownership is concentrated. This is financial engineering, not economic growth. It rewards the people who own the company over the people who work for it. It manufactures a short-term stock boost, which also happens to be tied directly to executive compensation packages, at the expense of long-term investment and widespread prosperity. But the buyback is only half the story. The other half is how Wall Street has hollowed out the rest of the economy.
Wall Street's influence is not limited to public corporations. The most aggressive financial operators, private equity firms, have taken over vast swaths of the American economy, including businesses traditionally considered Main Street staples, retail chains, healthcare providers, local newspapers, and even, critically, housing. The business model of private equity is simple, dramatic, and often devastating. Acquire a company using a massive amount of borrowed money, leveraged buyout, cut costs ruthlessly, slash worker benefits, reduce wages, sell off core assets, restructure the company to service the new huge debt load, resell the company for a quick, often enormous profit. In this model, the average worker is not an asset. They are a cost to be reduced. We've seen this play out in the national news time and again. A chain pharmacy is bought by a private equity firm, only for its staff to be cut, pharmacy hours reduced, and essential services compromised. The firm extracts value, leaving the community with the husk of the original business, a process that has been dubbed strip and flip. The impact on jobs is immediate: lower pay, reduced benefits, and often mass layoffs, all to boost the short-term profits that go directly to the firm's wealthy investors. The most visible casualty, however, is the very symbol of the American dream: home ownership. In the wake of the 2008 financial crisis, massive institutional investors, backed by Wall Street capital, flooded the market, buying up foreclosed single-family homes, turning them into rental properties. Today, they continue to outcompete individual families, driving up housing prices and making the entry point to homeownership nearly impossible for the middle and working class. The home, once a secure asset for a family, has been financialized, turned into a high-yield rental security for a distant investor. If you can't get a raise because the company is doing buybacks, and you can't buy a home because institutional capital has inflated the price, what's left of the dream? It would be incomplete to blame Wall Street without examining the role of the Federal Reserve and monetary policy. The policies intended to stabilize the economy have inadvertently become a massive accelerant for the very inequality we're discussing. Since the 2008 crisis, and dramatically again during the COVID-19 pandemic, the Fed has kept interest rates exceptionally low and engaged in massive quantitative easing, or QE. The goal was to stimulate the economy, but the primary unavoidable side effect was to flood the financial system with cheap capital. Where does this cheap money go? It doesn't go straight into Main Street businesses or higher paychecks. It goes into the places that are already efficient at multiplying capital: stocks and real estate. When money is virtually free, private equity firms can borrow cheaply to do those hostile, leveraged buyouts we just discussed. Corporations can borrow cheaply to finance those massive stock buybacks. This cheap money bids up asset prices, stocks, bonds, and homes, further increasing the wealth of those who already own those assets, the wealthy. The Fed's own data shows that during the COVID-19 pandemic, the wealth of U.S. billionaires increased by over 70%. This happened while millions of workers were laid off or struggling with inflation. The financial markets soared, divorced from the real-world suffering of the service economy. The central paradox is this: the financial cure for a recession, cheap money, has become the economic poison for the middle class, relentlessly driving wealth into the hands of the financial elite. The Fed is running a monetary policy that, however well-intended, serves as the ultimate guarantee that Wall Street can continue to financialize the economy. But there is an enormous risk to this entire system that Wall Street conveniently ignores. The danger in killing the American dream is not just a moral or social one, it's a fundamental economic threat. Wall Street has optimized the economy for short-term financial extraction, but in doing so, it has damaged the long-term foundations of the U.S. economy itself. Here's how. First, by prioritizing stock buybacks over wage growth, companies are sacrificing future productivity and innovation. The best companies invest in their people and their future. When money is consistently diverted to financial shareholders, core investment shrinks. We see a divergence where the stock market, the S&P 500, soars, while the underlying growth of total corporate revenue lags significantly. It's a high valuation built on sand. Second, the erosion of the middle class undermines consumer demand. As Moody's Analytics reported recently, the richest 10% of Americans are now driving half of all U.S. consumer spending. The economy is becoming dangerously reliant on the discretionary spending of a small, wealthy elite, rather than the stable, needs-based spending of a massive middle class. This makes the entire economy brittle and vulnerable to the financial market shocks that primarily affect the wealthy. If the bottom 90% of America can't afford a house, a new car, or even basic health care without taking on crushing debt, then who is going to be left to buy the products and services sold by those soaring S&P 500 companies? Wall Street has created a perfect machine for generating wealth at the top, but it has done so by consuming the very economic ecosystem that sustained the country for decades. It is an act of economic cannibalism.
So, has Wall Street killed the American dream? The financial evidence suggests it has replaced it. The dream is no longer built on a stable middle-class job and rising wages, but on asset ownership, a game the vast majority of Americans are structurally locked out of. We've seen the mechanics, the shift to shareholder primacy, the trillion-dollar buyback epidemic, and the financialization of Main Street assets like housing by private equity, all fueled by accommodative monetary policy. This didn't happen by accident. It happened through policy changes and the overwhelming gravitational pull of the financial sector towards immediate high-yield profits. The consequences are real, and they extend far beyond a balance sheet. They are measured in the difficulty young people face buying their first home, in the stagnant wages of a factory worker whose company uses profits for buybacks, and in the despair of communities left behind after a private equity firm strips a local business bare. The question for every investor, every policymaker, and every citizen is no longer, will the American dream survive? It is, can the world's largest economy remain stable and dominant when its financial markets are designed to systematically impoverish the majority of its own people? The current system creates immense short-term gains, but it may be building the conditions for a long-term, catastrophic economic instability. Keep your eyes on this developing story, because the greatest financial threat to the U.S. may not be an external rival, but the internal engine of financialization that is devouring its own foundation. The next great reckoning is coming, and it will be driven by the very people who have been shut out of the system.